Alright guys, so video 3 here is the 5 types of life insurance, okay? How do you know the differences between the types of life insurance and how they work, okay? So let's talk about that, okay? There are typically 2 types of life insurance, okay? That's what everyone's gonna know. What are they? There's term and perm. Term is like renting it. I mean, I pay my premiums, right? If I pass away, it pays out. If I don't pass away and the policy lapses or I outlive it, then nothing, right? I just rented it. Right? It only pays out if I die. Permanent insurance, right, is like owning the policy. I can build cash value, right? I own the policy forever. So let's go over comparing the 2, okay? So term, why do we like term? Initially it starts off really cheap. Over time the cost can go up, okay? But we typically have it for a certain amount of time, what, 10, 20, 30 years, something like that, right? At the end of time where if I die, I pass away, you know, it pays out. If I don't die after 30 years, policy goes away, no cash. Remember, I was just renting it, okay? So that's just a basic term, it's how it works. Now, permanent policies cost a little bit more, right? So some of your guys' policies, we're investing $100, $200 a month into them. Why? Because the cost of insurance is a little bit higher, but I want all the money I'm putting into it to go into what? The savings and the cash value accumulation that I'm earning, okay? So let's just say it costs a little bit more, but the premiums, meaning the cost of insurance, stay level, meaning they don't go up over time. And at some point I can stop paying for it and I can stay insured out till age 121, okay? So term, 10, 20, 30 years, really cheap, cost goes up over time, at some point in which it goes away, I don't own the policy anymore and I don't build cash. 2% of these policies ever pay out, 98% lapse or cancel. It's just the #1 moneymaker in the industry for insurance companies. Why? Because it's really cheap and a lot of people will get it. Is it a great product? Yes, because if you're 20 and you need it to be covered till you're 50, you can do that. The only problem is you're missing out on all the benefits of it. So you could get one of these for $11 a month, but there's no benefit to your retirement or tax benefits or asset protection or any of that stuff. So just know what it is, okay? And then of course we have the permanent policy, costs a little bit more, stays level, cost never goes up. At some point you no longer pay for it, you're insured out till age 121, okay? So now let's move on to the different types of permanent policies. What is the difference between all these permanent policies, okay? So there are 4 types of permanent policies that we're gonna talk about. The most popular permanent policy is called a whole life policy, okay? Most people have one. Now, I sell these when appropriate, just like I sell the other ones when it's appropriate, right? So let's go over the, which ones are appropriate and why. So how does whole life work, okay? Let's just say you have a $100,000 death benefit, meaning the policy you're purchasing means if you pass away, your family gets $100,000, okay? Now, let's just say over time, this policy is paying you a rate of 3 to 4% on your investment, and over time you have $25,000 in cash in the policy. Now, at this point, if you were to pass away, what would your family get? Well, what you want to explain to the client is in a whole life policy, if you pass away, your family gets the death benefit, but the company keeps the cash. It's not your cash. This is why I did not sell you guys a whole life policy, because the cash needs to be your cash. Does that make sense? Okay? So, now you say, well, wait a minute. You told me that I built cash at 3 to 4%. Yes. But in a whole life, you do it in the form of more of a loan account, meaning I can borrow $10,000 out of here, but where do they get the money from? Well, if you got $25,000 in here, that means you've got $10,000 to borrow, right? So you can pull your $10,000 out. But they're actually taking it from your death benefit because it's not really your money. If you pass away, your family will only get $90,000, not the $100,000. And you say, well, wait a minute, I need my family to get the $100,000. So you say, great. Put it back in, repay the loan. But they're gonna charge you 5 to 8% to borrow your own money. So here's the question. Mrs. Jones, Marquise, Leslie, if you went to your bank and said, I need to take $100 out of my account, and they sent you out an envelope with $92, Would you bank there? No, we wouldn't. We'd find a bank with what? No fees and penalties, okay? So is this a bad policy? No, it's just what it is. It's suitable for certain people, it's whole life. Meaning if I was a little bit older and I wanted to keep the cost of insurance down because I didn't have time to build cash value, but I wanted a permanent policy that would still insure me out to age 121, this might be a great product, okay? Just understand that the company keeps the cash. You're not truly growing your own money in a whole life, okay? There's just a big misconception and a big misunderstanding. You'll replace a lot of these policies in your career because people have something else that they think they don't really have, okay? Now, let's move on to universal life policies, okay? And that's what we call a UL, okay? Let's say you have 100. Let's say you're getting that same 3 to 4% return, and over time, $25,000 in cash value, okay? If, again, what's the question? If you pass away, what does your family get? Well, in a universal life, they get the cash and the death benefit. If you borrow money out of it, $10,000, and let's say there's $15,000 left over, and you pass away, the family would get the $115,000. They would get all of it because it's both yours. Now, also in this policy, there's still a loan fee to borrow the money. So if you say, listen, I want to put this money back in, I don't really want to pay the loan fee though. Listen, it's okay, because remember your money is growing at 3 to 4% versus a bank. So even though you might pay that fee one time to borrow that money, remember I would talk to your advisor and insurance advisor and everything first before making the decision, Mrs. Jones, right? But understanding that even though you're paying that fee one time, that's still your money. So it might benefit you to have your money growing at 3 to 4% versus a bank where it's growing at point something, okay? Now, are all ULs the same? No. What's cool about this is you guys have heard of smartphones, smart cars, right? One of our carriers is a company called Foresters, okay? They have a product called what? A smart UL, right? Now what does that mean? It means a couple things. After 7 years, for example, that loan fee goes away. Now that's a product specific compared to what? A UL. So there's a UL and there's a specific UL by a certain carrier, right? That says after 7 years, that loan fee goes away and all the money can be taken out and put back like a checking account with no penalties, and the money's still growing 100% tax-free. This is very popular, right, with that company, okay? But understand the difference between a smart UL and a UL is that this is actually a specific company that has a benefit, right, versus it just being a UL, okay? Now, there's another type of UL, and I'm going to tell you up front, it's one that I don't sell, okay? We don't sell them, okay? And I'll tell you why. It's called a VUL, which means variable. And if it's variable, it means it's made of what? Stocks and mutual funds, okay? Which means that if the market goes up, you can lose, or the market goes down, you can lose. So let's go over that, okay? In a VUL, let's say you have 100,000. Say your money grew to 25,000, right? It's growing here at a different rate because it's actually what? Stocks and mutual funds. Which means if the market goes up, your money goes up. If the market goes down, your money goes down, okay? Now, what are the benefits? Well, what if I pass away? That's the question. Your family gets both. If you borrowed money, family gets both, right? If you want to put it back in, you can. There's no loan fee. Sounds great, but you have to understand in stocks and mutual funds, you have what? Market ups, market downs, which means there's risk, which means if the market tanks 25%, you lose 25% of your money, okay? Also, understanding what? There's fees for what we call money under management because it's what? In the stock market. So it's a managed product. So here's the question to remember, the thing to remember is this. If the market tanks 20% in this product, I'm still paying a fee to lose money. Do I want that? And the answer is no. So I won't sell those, okay? I'm not a fan of them. Can they be beneficial to some people? Yes. To the average middle American who's trying to grow their money for retirement savings, no, it's probably not, okay? It can be appropriate for some, but we won't see a lot of it for us, let's just say that, okay? Now, last we have the IUL, which is the answer to the VUL in our industry. If we don't like the VUL, what do we use? We use the IUL. This is what you guys own, which is what's great, okay? So, what's the question? If I was to pass away, what would my family get? Your family would get the $100,000 plus the $25,000. They would get all the money, right? Now, if I borrowed the money, you can borrow it. If you pass away, the family's got whatever's left. If you borrowed $10,000, they got the 15, they get whatever's left. There's no fee, okay? But the greatest benefit to this product for you guys is what? The fact that it's what? Credited through the indices. What are indices? S&P 500, NASDAQ, Eurostock, Hang Seng, all the big conglomerates of companies that make up funds. So it's called an index fund, or a group of the top 500 companies in the stock market is the S&P 500, okay? Now, the way it's credited is if the money goes up, your money goes up. If the money goes down, you don't lose anything because you only make money on the ups, but you never lose money on the downs. Now, how do they do that? That's always the question, okay? It's through something called ratcheting, okay? And I want to liken it to when you tighten a bolt with a ratchet, when you bring it back, there's no tension, you can just keep cranking down on the bolt. So every time you lock that bolt down, it gets tighter, but it stays tight. It stays locked in. If the market tanks, you don't lose any money. It doesn't loosen the bolt back up, okay? It's called ratcheting. I'll explain to you how that works. But if the money goes up, you just don't get all the ups. Say the market does 20%, you're gonna give up a couple points. You might only get 18%, 12%, 15%, and that's specific to your contract with the carrier, okay? But if the market goes down, you'll never lose a dime. And also, you can grow all your money, what, tax-free, like we were discussing earlier, is one of the benefits. And this is why people like Mark Cuban like these types of products, right? Because of what? Their ability to grow their money risk-free, but still have all the death protection benefits available to them and their families. Does that make sense? Okay? So there's a sixth type of life insurance, guys, out there, okay? A sixth type, and it is a term. I told you there was term and perm. This is a second type of term, okay? This was very popular too. It's called ROP. And the question is, do you have car insurance? Yes. Do you pay it every month? Yes, right? If you went all year with no tickets or accidents, would you like it if your car insurance company mailed you a check back for all your money? Yes, of course you would. Great. Well, there's life insurance that does the same thing. If you don't die, they give you back everything you ever paid. Unlike a regular term, where if you don't die, contract's up, it just goes away, right? So this is an answer to the people that say, well, I like life insurance, but I feel like, you know, I'm wasting my money if I don't die, but I can't afford one of those IULs. Okay, this is a great idea, okay? So how does it work? Well, it's really that simple. It's cheap, right? It's cost effective, and if you don't die, you get all your money back. But here's the thing, how does it cost? Well, your traditional term is what we call one time, right? And if an IUL is what we call 10 times, ROP would be what we call 2.5 times. And what do I mean by that? Meaning if your term costs $10 a month, your IUL might cost $100 a month. This one's gonna cost $25, right? It's gonna cost about 2.5 times more than a traditional term, but what is the benefit? When you pass away, every dollar you ever paid times 12, right? Times however many years you paid, you get all that back. Maybe it's $25,000 or something. You can then take that money and decide what you want to do with it. So while you were making payments, you were covered. And now that the policy's over, I got all my money back because I didn't die. Now what do I want to do with my money? This is a great savings tool for people, okay, that don't want to afford the IUL. However, I always urge everybody to go with the IUL because of the other benefits, the tax benefits, right? The tax control benefits, right? The asset protection, the probate protection, all that stuff. So keep in mind, they're all different tools used for different purposes. And I'll teach you guys more about blending, like why and when I use an ROP versus an IUL and how I work them together. So we'll talk more about that. So this is the 5 types of life insurance, okay? I want you to watch this video